Welcome back! Today we're diving into a hot topic: gold versus equity versus real estate. Which one should you invest in? Let's break it down. We all have different goals, starting amounts, and risk levels. We'll explore historical performance, potential upsides, downsides, and investor suitability for each. By the end, you'll have a clearer picture of how gold, equity, and real estate stack up. Let's jump right in. Alright, let's kick things off with gold. Gold has been a store of value for thousands of years. When people get nervous about the economy, they often turn to gold. It's like the financial world's security blanket. During economic uncertainty, geopolitical turmoil, or high inflation, gold often holds its value or increases. It's more about wealth preservation than getting rich quick. Gold tends to zig when other assets zag, valuable for diversification. Gold as a hedge against inflation is a classic move. When currencies lose purchasing power, gold prices historically rise. Holding gold can protect your wealth from inflation. Gold is a tangible asset, providing a sense of security. You can literally hold a gold coin or bar in your hand. This tangibility is a psychological comfort. Gold is generally quite liquid, meaning you can buy and sell it relatively easily. There's a pretty active global market for gold. You can invest in gold in a few different ways: physical gold, gold ETFs, or shares in gold mining companies. However, gold itself doesn't generate any income. A gold bar doesn't pay dividends or generate rental income. Its return is solely based on price appreciation. If the price of gold stays flat or goes down, you're not earning anything. Storage and security are considerations for physical gold. Storage fees can eat into your potential returns. Gold's price can still be volatile, influenced by many factors. Timing the gold market is tricky. Many financial advisors suggest allocating a small percentage of your portfolio to gold. It's not usually the star player, but a reliable defender. Gold tends to perform well during high inflation, economic recessions, or market fear. Investors flock to gold as a safe haven. Understanding macroeconomic triggers can help you understand gold's movements. It's one piece of a much larger financial puzzle. Next up, let's talk about equity, or stocks and shares. When you buy equity, you're buying a small piece of a company. If the company does well, the value of your shares goes up. The big draw for equity investments is the potential for high returns. Historically, the stock market has provided returns that outpaced many other asset classes. Companies can innovate and increase earnings, driving stock prices higher. The magic of compounding can grow your investment exponentially over time. Many stocks offer dividends, providing a steady stream of passive income. However, the stock market can be incredibly volatile. Prices can swing wildly based on various factors. You need to have the stomach for these ups and downs. Market research is crucial if you're picking individual stocks. Diversification is key to reducing overall risk. ETFs and mutual funds are great for achieving diversification easily. An S&P 500 ETF allows you to invest in 500 of the largest US companies. Long-term investing in equities is generally about buying and holding quality assets. Short-term trading is riskier and often more like gambling. Economic factors play a huge role in the stock market's performance. Understanding macroeconomic trends can give you a better sense of the market environment. There's a big psychological aspect to investing in equities. Sticking to your investment plan and avoiding emotional decisions are crucial. Fear and greed can lead to poor investment choices. It's about time in the market, not timing the market. Equity investments can provide significant wealth creation over time. The potential for high returns attracts many investors. Reinvesting dividends can further fuel the compounding effect. Diversification helps cushion the blow if one stock or sector takes a hit. ETFs and mutual funds offer broad market exposure. Long-term perspective is usually the way to go with stocks. Discipline is paramount for success in equity investing. And last but not least, let's dive into real estate. Investing in real estate means buying physical property with the expectation of generating income or appreciation. One primary attraction is the potential for rental income. Rent paid by tenants can cover costs and provide positive cash flow. Beyond rental income, there's property appreciation. Over the long term, real estate tends to increase in value. Leverage allows you to use borrowed money to purchase property. This can significantly amplify your returns. Real estate also comes with attractive tax advantages. Landlords can often deduct expenses like mortgage interest and property taxes. There are many ways to invest in real estate: single-family homes, multifamily properties, commercial properties, or REITs. REITs offer an easier entry point with less direct management. One hurdle is the initial capital required. Real estate is generally considered an illiquid investment. Selling a property can take weeks or months. Management responsibilities can be a lot of work. Hiring a property manager will eat into your profits. Location is critical in real estate. A property in a desirable area is more likely to appreciate. Real estate markets are cyclical with booms and busts. Understanding local market dynamics is crucial. Real estate can act as a hedge against inflation. Property values and rents tend to increase with inflation. Real estate is a popular long-term wealth-building tool. It's a tangible asset providing a unique sense of security. So which investment is right for you? It all depends on your financial goals and risk tolerance. Let me know in the comments what you think. Don't forget to like, subscribe, and hit the notification bell for more financial tips and insights. See you next time. Gold offers stability and inflation protection but little income. Equity provides high growth and dividends but comes with higher volatility. Real estate gives rental income, appreciation, and tax benefits but requires significant capital and management. Often, the best approach involves diversification across different asset classes. Educate yourself, understand the pros and cons, and make informed decisions. The best investment strategy aligns with your long-term objectives and lets you sleep at night. Thanks for watching. Smash that like button if you found this helpful, and I'll see you in the next video.